As we head into the trade wars, a hiking Fed and potential global slowdown is defense, your best offense. Pete Najarian, what do you say?
You know, I've never liked it. I've never subscribed to that whole idea.
Although you played defense.
I did play defense. You're right. I was a middle linebacker, so that's 100% true.
Okay.
No, but you know what? I don't like the idea of if there are better reasons than just defensive reasons to go to a Kellogg, to go to any of the names that are out there that had unbelievable days today. I mean, one of the names that stands out for me is Kroger, which everybody put out for dead after the big buy of Whole Foods from Amazon about a year ago. Stock went from 29, got all the way to 20, bounced back up, and here it is at 29 again. But I think that one makes sense. I think they're able to compete. And as long as you can compete in today's environment, I don't look at somebody like that, Kroger, for instance, as a defensive stock. But, you know, let's not just totally push off to the side. Technology had a great day as well. So it wasn't just, I mean, there was defensive names, but technology was off to the races once again.
But when you talk about names that are defensive, Pete talks about a name with a story behind it. So when you look at some of these other names, these food stocks, they have stories behind them too. So you see M&A in the space. Technically, they look like they're breaking out. Utilities, to me, is what Pete said, defensive, but they could pass on the rising rate environment to clients, to customers. So I think that is a defensive play that I would stay with. The other ones
are... Food stocks or not?
Food stocks, case-by-case basis. I would have to look at technicals because we truly don't understand how long that M&A pop can last in a defensive world that we're living in now.
Isn't there something to buying a stock that sells stuff that people need all the time? Well, and that has a yield, a decent dividend yield that could help buffer you from downside?
Well, theoretically, but where do they buy that stuff? They buy that at a grocery store. And what's happening to the grocery store industry, right? It's getting more and more consolidated. There's more power in fewer number of hands. So that changes the balance of power between, you know, a Kellogg or a General Mills who used to be able to just take price, you know, they would be able to raise price at will.
And they can't
anymore. Can't do that anymore. And so private label also is pushing them. The other thing for me, a dividend is
the wrong reason.
The wrong reason, absolutely. Yeah, I think we're going to see inflation. We haven't really seen much of it lately, but I think we're going to see it. So the dividend provides me this much protection. You could lose the whole dividend in a day.
I think they're defensive because I think they're offensive, not offensive, but offensive. I mean, I think
you hate them.
Well, these things were getting so pushed around, and if you think about the rate scare that we had, Kellogg's, you know, dropped 25% during that period, and I think Kellogg has very real drivers. I think they have one of the best balance sheets in their space. There's a high short interest. Their margins are growing. They've got this direct store experience. They've got different reasons. Their snack business. These are all excellent reasons. But I think in a rising rate environment, and I still think we're in a rising rate environment, at least at the short end of the curve, I think the market overall goes through a compression period. I think these stocks are very expensive. I think these stocks were very, very attractive when rates were almost zero. And in fact, people were willing to pay more, and these stocks made. And because of the dividends that Karen's loath to really chase, which I think she's right, that's why. So again, back to AT&T.
How expensive are they?
Same deal. Well, I think these guys are trading anywhere from 15 to 20% past their 5-year averages, and if you look at that, I think a lot of that's
except for maybe Kellogg. I mean, the one pushback I'd have, and I agree with everything you were saying on the positive side with Kellogg, but it made sense. It's not necessarily defensive, but at a 15 PE, if it's last couple of years running at a 17, it's a little bit sounds like it's actually not that bad, even though it's hitting highs. So that's one of the names. I think there are other names out there, but that name's actually kind of intriguing to me. The fact that they're doing
that could be a defensive stock in your view.
Well, but I don't want to buy a defensive. I want to buy a stock that has growth. You mentioned some of the margins, some of the efficiencies that they've moved towards. All those reasons actually are what pull me in, Mel. The fact that maybe we look at it as defensive, that's not anywhere. It's right up there with the dividend thing. It's one of the last things that I'm looking at.
It is odd to me, though, that Kellogg specifically is butting up against resistance that's a year ago old and actually broke through. So there might be something a little bit more under the hood technically and maybe fundamentally that we don't know yet. So everyone always thinks, do the technicals show it first and then the fundamentals follow through later? I don't know, chicken or the egg. But right now, technically, Kellogg sets up.
I think your M&A, which you mentioned at the beginning, that is something. That is a potential catalyst. We'll see. I mean, if Campbell's doesn't get any price or doesn't get a good price,
then the others sell off. Right.
But and I would just, look at, I know AT&T obviously has a world of stories around what's going on there. But AT&T and Verizon and a lot of the big div stocks and a lot of the big yield plays in telco and utility land, I think we're hammered. And I think we're now getting this kind of relief. I think it was overdone. I think people realize, we've talked about it in the last couple of weeks. Look at that 10-year chart. You may have a head and shoulders. You may see rates going back to 260. I think we will. So, I mean, I think that's been a major boost. Yes, you've had the backdrop of global trade wars be a reason to jump into some of these things. But as Pete pointed out, I mean, the semis have been pretty badly beaten up. But if you look at triple Qs, we're still, bouncing along in the 50. That's a chart that's not really in trouble to me. And I think I'd rather own that in a difficult time. We said those are defensive stocks.
Right. So if defensive stocks are not defensive in your view, Pete, technology is defensive.
Well, I think it is because the fundamental story is there and the growth story is there.
How can technology be a great sector to be in when you need defense and when you don't need defense?
Well,
have it both ways.
I'll give you a great example of a defensive stock would be a Microsoft. Look at the valuation, but also look at the growth. When you look at the growth in the cloud aspect of it, which is exactly what Satya Nadella was set out to do years ago when he was established as the CEO, he looked for the growth area that he came from. That's where they're going. And when I look at their dividend, when I look at their buybacks, and I look at all the fundamental story of a Microsoft as one example, I think that there's a great opportunity. I think $100 seems a little bit cheap, actually, right now for a Microsoft. I think it's a $110, $115 stock.
Well, if you ask Pete that same question, go back 5 years on performance. 5 years ago, we've had some areas where we needed defensive stocks, where we needed some growth stocks, and technology, by and large, has outperformed for the last 5 years and probably longer than that as well.
Does that make it defensive?
That makes it both. Unfortunately, right now, we're dealing with the headwind of a trade war that puts it right in the bullseye. But ultimately, when the smoke clears, this is both offensive, not offensive, and defensive.
So let's go with, let's see how offensive some of these defensive stocks are. What we're going to do right now is trade it or fade it.
Like it, yeah. Again,
Kellogg.
A nice little game.
Let's start with Kellogg. I mean, we had a nice, robust discussion on Kellogg, Tim.
I think you trade it. Again, I think management here is in a very good place. I think they've given us
trade it, mean buy it.
Yes, it does.
It's so clear. I don't know why everybody doesn't get that.
No, I know Guy's not here, but I just want to make sure we're all on the same page.
Yes, I would stay with this rally. I would trade it, and I would stay long.
Pete?
Totally agree. And I look at the valuation like we were talking about. At a 15 PE forward, this cheap, actually. I think it's a trade.
Clorox, Karen.
Clorox. I mean, I don't know. I don't love that. I guess I would sort of fade it. None of them are crazy expensive, right? But the idea to me I'm going to get out of something that I really like because this may outperform for a month doesn't make sense to me. Right. I'm not going to do that. So I will fade it.
Okay, Grasso?
I would fade Clorox as well. And I go back to what I said before, when I don't know what the fundamentals are going to be going forward, because no one truly knows. I look at the technicals. Technicals it looks like it's failing right now at prior resistance, so I would fade that one.
Church and Dwight. Tim?
I tell you what, very diversified brand. This stock's been on a tear. I think some of this is due to, again, management guidance and better margins, and I think they do very well in this environment where the consumer has more money to spend. I'll trade it.
Pete?
The story's improving. The margins, as you talk about there, they are doing what they need to do to put themselves in a position for 2018.
Yeah.
And so because of that, I'm going to trade it as well.
16% gain in 1 month. That's amazing.
Pretty impressive.
Yeah.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.